day, master investors. Uh, the editors very kindly asked me to speak at some length, not great length, I assure you, about matters to do with investment. And I'd offer you some notes which I've picked up along the way, and I trust they are of interest. Provided I don't get too many inquiries from people, I'm quite happy to deal with emails which people might want to send. But I might have so many, I will just have to say no. But I'm by no means there yet. So uh, I just mention it as a general acknowledgement, general recognition. Anyway, one of the things that always amazes me about capital markets is how uh, I always think that things will go normal for the forthcoming year. Then, as the year progresses, it's anything but normal. There are always quite extraordinary tensions and revived features in events, which I say revived features. What I mean by that, I mean there are features which you would think would never occur again, but they do, and it's fascinating to see them observed because they are always the backdrop to any decision which one has to make. One of the most notable features in London over this last year has been the astonishing gap between America and this country. America keeps steaming ahead, and whereas we are really putting in a very pedestrian performance over here, I'm not sure why that is so. I'll come back to it in a moment, if I may. But in the way that politicians do, and the LSE, either London Stock Exchange, not London School of Economics, do, they'd like to have more investors investing on London. And as a result, the coterie of those who like to influence policy are asked to come up with a magic wand. Well, I don't think it's so easy to find a magic wand. However you look around, uh, within the next 24 hours from today's recording, um, the Chancellor will stand up and offer his budget speech. Whether that'll include some magic stimulus for investing in London, I don't know. I doubt it, but anyway, it's what they're looking, our masters, shall we say, are looking for. I think it's a mistake. The fact is, all rules relating to a business are important if they make the business work, but all rules relating to classification of investments, simply for tax purposes or for deemed social purposes, are a complete waste of time. I mean, that unpleasant fellow, Gordon Brown, got up to it. I did it 16 years ago on stopping short selling on small caps because a lot of fools kept on badgering him to do something about it. The result is we are now in a king-size mess of grotesquely overvalued dross, and there's nothing to be done about it other than short selling them to destroy them if possible, or to destroy their capital raising prospects. Well, that's what happens when you get a politician playing the fool. And I'm sure they'll have another go at it. The one that seems to have been quite appealing to the authorities or those who instigate policy has been the introduction of a British ISA. I know that Mark Watson Mitchell, my colleague at Master Investor, seems to be quite drawn to this idea, but I, if respectively, disagree with him because a British ISA is incapable of being defined satisfactorily. Is it an ISA which is only bought by Britons? And who is a Briton? Is he a Briton who's resident in this country for tax? Is he a Briton because he feels British? Is it an ISA with British investments? And if British investments, what is a British investment? Well, you can take Greg's sausage pie shop or whatever. You can call that British. But I'm pretty sure that nobody else anywhere else in the world would respond to a Greg's pasty, and, and therefore you could put Greg's in a British ISA. But if it's a British oil company, like say BP, they sell product all over the world, and there's a lot of shareholders who are not British. So what's proposed by a British ISA, I cannot begin to imagine. However, I don't rule out some fool in the policy determination department who will come up with a wheeze. It'll be superficially compliant with the imagined objectives of the British ISA School of Investment, but I doubt if it'll succeed. I just can't see that at all. Anyway, that's something on the way. As I say, we may find out in the next 24 hours. Not that I'm an optimist there. It's astonishing that the tourist tax, as the Daily Mail calls it, seems set to continue because there's a loony school that if someone comes over and buys a handbag for £1,200, they don't notice there's £200 VAT included in that price. And understandably, customers who come to this country to buy a handbag, perhaps they're lunatic to start with, I don't know, but the fact is that when they arrive in this country, it's not impossible for them to say, well, goodness me, say I'd gone to Paris or Rome, I could have achieved exactly the same purchase, but it would not have suffered £200 VAT. So inevitably, they make a note for the future not to come to London. And they tell their mates not to come to London. And in not coming to London, they don't go to restaurants, hotels, and doctors in London. So unless this tourist tax disappears, I'm afraid the British economy is going to just be shooting itself in the foot. So we'll see what happens. For many years in this country, it was possible to get tax relief on interest paid on loans to buy shares. And a lot of people responded to that by borrowing at crazy rates of interest. And as a result, people were very excited about it. But the trail of paperwork which led on to the completion of tax returns was not acceptable to the Inland Revenue. After all, what is the interest taken out on loans? Does it include credit card interest? Does it include a loan taken out to improve the fixtures and fittings of a house? But actually, half of it spent on shares. I mean, it was an endless mess. And in the end, I think 1973, that was stopped. The significance of it was that by pumping up asset values, and if people are buying shares and holding them, which they might be more inclined to do, were they paying interest on the loan to get it, is that the higher share value give the holders a reason to get excited and spend more money, for all I know, on handbags. But the fact is that it was a mess, and so the government stopped it. I'd be surprised if this theoretical improvement in the economic climate in which investors operate were revived. That I can't see. I suppose I'm taking quite a long time to get round to my point, which is that for some reason, shares in London are very cheap by comparison to America. And I think this is a tremendous bullish opportunity. I mean, I think it's just huge because it can't go on like this. Either America collapses, which it might, or British shares, or shares quoted on the London Stock Exchange, we say, will tend to go up. Roughly speaking, companies with comparable growth prospects in London are trading at half the price earnings ratios of those applying in America. Well, this, as I say, this can't go on. Well, I may add, on continental Europe, there are higher price earnings ratios. So the climate seems to me very strong. As regards the areas which I think investors have to consider, one of them, for those who are of a passive nature, which I am not, but the fact is, for those of a passive nature, the investment trust sector in London is huge. There are not tens of undervalued investment trusts, there are hundreds. And the opportunity for investors to put aside holdings on the long term are just huge. For instance, the British government has a disease on its hands, which is that the British just love to pick up money for doing no work at all. There's nothing more absurd than how people buy residential property in this country. Then they do nothing of any consequence as regards the development of property. And if it goes up 20%, these holders think they're amazingly intelligent. They go around with a sort of glow inside their tiny brains, and they vote for the incumbent government. Well, I hesitate will mean the Conservatives stay on. But the fact is that it'll be just the same if Labour comes in. They'll still go through this inane perpetuation of disease, and perhaps we won't address what I think should be addressed, which is sensible long-term investment. Now, for those investors who can take the long view, the answer, I'm sure, is investment trust. And here, the range of services available in London are really quite considerable. Two firms that come to mind are Peel Hunt, and another one is an American firm called, or American originated firm called Stifel, spelled Stifel. And for someone who's got a really handsome sum, I think, say, upwards of $250,000, a meeting with these characters makes a lot of sense. Where the where the investor must take care is to stop these people having discretion over the portfolio, which is a pity. If these chaps are given discretion, you can bet your boots that after 5 years, these investment trusts will be sold in favor of another trust, because that's the way commission is generated. It's got nothing to do with investment sense. And to arrange matters with the broker, such that this disastrous economic approach is ignored, is a matter of study by the investor. It's not an easy problem. I've discussed from time to time with Jim Mellon the possibility of Master Investor running an investment trust service, but there are really two objections. One is the wretches at the FCA who will want to get involved in the regulation of it, which costs a lot of money, with nothing whatsoever to show to the benefit of investors. And that doesn't bother them as long as they're sticking their nose in and making a mess of it. They can preen themselves all day long as they gravitate to the age when they can pick up a pension from the FCA. And the other reason is that to do investment trusts properly involves having a dedicated studying unit. It doesn't have to be perfect, but it must be based on continuity and one or more officers who will stick at it year after year. That's the way you find out what's really going on in the investment trust world. You get a result. You know, the ignorance which attaches to some investment trust management is quite breathtaking. Quite a few years ago, I found myself trading the fitness sector. I had various reasons for doing that. And I was in the city for drinks one evening, and I met a young lady who had a portfolio which could include fitness clubs, and indeed had to include fitness clubs. And I asked her about a company, and she had never heard of the company which I had in mind, although it was fully quoted and operating. It wasn't a tiny operation either. She just didn't know. And I'm afraid some investment trusts are astonishingly badly managed, because those who install managers in investment trusts, the non-executive directors, don't insist upon continuity being achieved as a condition of contract of employment. So it's a problem. I don't know what the answer is. There's Nick Sudbury, of course, who does investment trusts for Master Investor from time to time, and he knows a lot about the sector, but he's rather confined to major trusts like, say, Rothschild Capital Trust Investments. What's it called? I can't remember. It doesn't matter. And things like Caledonia and so on. And he knows these companies well. And investors could do worse than read Nick's sayings on things. He's a chartered accountant by training, and although long retired from the city, he certainly knows his stuff on investment trusts. So there's an area for investors to consider if they want to look after their money in the long term. Funnily enough, this is not easily dealt with, and I've tried to simplify these matters over the years, and I've never succeeded to my satisfaction. But there is one investment trust to which I have alluded before on my column at Master Investor, which is, to my mind, astonishingly cheap. That's New Star Investment Trust, ticker code NSI. And I've known about this since forever. The original manager, who's still alive and whom I regard as a friend and often see, is Alan or Mugger Miller. He came over from Jupiter to establish New Star investing, I don't know, about 20 years ago, alongside John Duffield. And they decided they would have an investment trust. And one of the major investors was and remains John Duffield himself, who still owns about 60 or 70% of New Star. And it's managed by now, after the collapse of New Star, it did not go over to Henderson, as did all the other interests, but it remained managed by John Duffield's management company, Brompton Asset Management. Now, the fact is that John Duffield is not a fool. He's a very clever man. And the only problem he faces is age. I should think he would be around 85, 87. And the fact is that there are two things that can happen to him. One, he can die, or he can go gaga. Well, when I last considered him, he certainly isn't going gaga. So he just may snuff it one day. And the significance of this is that the net asset value, or tangible net asset value, of New Star is around 185 pence a share, as against a buying price for New Star of around 120 pence. And sooner or later, it will be possible to buy in the capital of New Star. Though, of course, John Duffield doesn't want to do that, since he's quite happy in the belief, from his and his family's point of view, that these shares will just progress. Say for someone who, say, got a good lump of wodge, which they'd like to stick away on a 10-year view, this seems to me a terrific opportunity. There's a minute dividend paid of the order of 1% or so. That really doesn't matter. One day, this investment trust will come good. The only problem is, from my point of view, from my family's point of view, is I don't know what that day will be. All I know at the moment is that people just can't be bothered to take a 5-10 year view of events. They'd like to trade it knowing they'll get out at a profit in 6 months. Well, that's just nonsense. It doesn't make any sense at all. So I urge investors who want to take the responsible long-term view, investment trusts are the way forward. And furthermore, I draw investors' attention, if they haven't already heard me remark upon this before, to New Star, NSI. It's a good wheeze, at least I think. Of course, I've been touching upon the fact of American investment markets being at least twice the price of British investment markets. And I think there are some reasons for that. The Americans take capitalism very seriously. And by goodness me, it's been a huge advantage to America. In America, for instance, if you're not a satisfactory worker, your manager can sack you pretty well at an hour's notice. without a long discussion about it and a tribunal and all that sort of nonsense. In Britain, where we're determined to fail if we can possibly make arrangements to ensure failure, it's a much more expensive affair. And be no doubt that if Labour get in October 2024, which seems very probable, they will insist upon completely stupid laws relating to labour. It doesn't do the British economy any good at all. And we just have to live with that. Anyway, there's another elephant in the room. In America, the debt, the overall debt of America as a government is staggering. It is beyond understanding. In its way, it's as bad as it is over here. And as a result, and also elsewhere around, there will surely be a day of reckoning when the capital markets section in the debt sector will simply refuse to subscribe for American government debt and the debt of other governments. And of course, when that happens, these governments will seek to go on raising debt, and they won't succeed. And that means that equities could get thumped. Well, I, for my part, would much sooner be in British equities when that happens, despite the fact that British equities are undoubtedly directed to overseas markets. Indeed, this country is the biggest overseas markets participator you can imagine, by the way, taken as a percentage of the economy, British economy as a whole. And so as a result, there are dangers. But the alternative is to claim to know when all this will happen. And I'm not so sure. And if there's inflation, does one really want to have cash hanging around in one's bank with the likes of Nat West or some other bunch of ghastly people are able to help themselves one way and another to the use of your capital? Well, I personally would steer well clear of that. It's no good at all. So again, one, I think, has to go back to investing in the in traditional equities. It makes a lot of sense. Incidentally, whilst I remember, John Duffield, as I say, a very clever man, used to be married to one Vivian Duffield. She was the daughter of Charles Claw, who had a huge business in central London 70, 80 years ago called City Centre Properties. And he really knew what he was doing. He knew how to get people to take a long-term view of investment, and he built properties to meet those requirements. Anyway, Vivian is no fool herself, I can tell you. And she remarked in relation to her marriage to John Duffield that my husband was a very good stockbroker, but a lousy husband. the two skills of marriage and investment management can be quite separated, and the world goes on. Actually, talking about that, I see in this morning's Times that Crispin Odey is apparently considering a return to fund management And whatever difficulties he had or didn't have, I don't know what they are or were, in the woman relationship department, I'm quite certain his brain is entirely switched on. And if he starts up OD Asset Management Mark II, I get involved in that. He is a very bright bloke. I think he got a scholarship to Harrow, and not that his family needed the money, but he was really, uh, he got A levels at a very young age, something like 15 or 16, and just walked through matters. And I've spoken to him from time to time, and he is very intelligent. So there's another thing to keep an eye open for: the return of Crispin Odey to public management of funds, with or without the Financial Conduct Authority in attendance. It's a bit of an opportunity there. Funnily enough, on the matter of fund management, a member of my family seems to know what he's doing. That's my nephew, Thomas. He's an over Gruppenführer investment manager on the west coast of America. He lives in Los Angeles, not Los Angeles, I beg your pardon, San Francisco. And he works for a business called Aldbourne, Aldbourne. And Aldbourne doesn't deal with the public. They have major clients who need to select investment managers. This is really quite a skill. And Aldbourne have been doing this very successfully for quite a number of years now. And as a result, my nephew is well paid. Well, I don't know what his negotiations with Aldbourne are on a year-by-year basis, but he's not short of a bob or two, I can tell you that. And what he had to say to me is that in America, things get done, which they don't over here. And that's something to bear in mind. Turning elsewhere, as I consider things that might be done over here, there's a little company which engages me called Webis, Webis. Ticker code is WEB. It's only capitalized at about £5 million. And you buy the shares, well, you were able to this morning at 1.2 pence. I've no idea what they'll be in a week's time. But anyway, this is controlled by Jim Mellon. And from time to time, I've touched upon it with him, the boss, Ed Cummins, and the chairman, Dan Amick, who lives in the Isle of Man, not far from Jim's. And this is a very interesting company. There's hardly any asset in the business on the balance sheet because, for one reason or another, Webis keeps on recording losses. But I suspect that this is coming to an end. It's had a lot of adverse weather in America, and it has terrific opportunities. If I can give you one example, they have an agreement with a company called Monarch, which is controlled by a Canadian entrepreneur, a billionaire, called Frank Stronach. And they've got terrific race courses in America. Just to reel off three: there's Santa Anita in California, Gulfstream in Florida, and Pimlico in Maryland. Now, these are big race courses. It's not to be confused with your country course, such as you encounter in Australia. And as a result, investors all over America like to have a bet on them. And they can do that now through Webster's subsidiary, Watch and Wager. And I think Webster's has got a tremendous range of contacts which have been accumulated over time. And Americans are increasingly turning to sports betting. For many years, there were a host of loonies who'd rather that the mafia controlled the betting which American citizens engaged in. So if you sit down for a beer at the corner of some bar in the middle of nowhere, a chap would come up and see that you were looking at the racing on the television, and he'd let you have a bet with him. Let you, by Jove. The prices were very bad, but for the punter, he couldn't get any money on anywhere else. So he'd hand over his $100 to the representative of the mafia or whatever and sit and watch his race. Well, eventually, the Americans decided they'd have to stop that. And there's no doubt that the Americans are turning to legalized, regulated sports betting. And I think Webber's could be a huge beneficiary from that. It has a small race course near Sacramento. It's harness racing, which doesn't interest me. But they do, Ed Cummings definitely knows about race courses. And I think that's going to give Webber's an advantage in time to come. So for those who want to put aside a couple of £1,000, they can put in more if they like. Webber's is an opportunity. Where it leads to, I simply don't know, or when, I don't know. But Denemique has clearly invited or drawn attention to inquiries in his latest statement to investors, which accompanied the half-year results. And therefore, that's another little thing to think about. It can go in an ISA too, which may appeal. I say it appeals, it should appeal. Funny things go on. For instance, if I may return to investment trusts at the moment, there's an investment company quoted in the Channel Islands called Golden Prospect Minerals, GPM, on London, quoted on AIM, and it's incorporated in the Channel Islands. So technically, it's not an investment trust, which is a British idea for companies resident in Britain who are involved in investments. It's really an investment company. And a friend of mine formed it with his colleagues about 25 years ago, something like that. And when through retirement and so on, they sold out, it went to an Australian fund manager called Hintze, Hintze. And incidentally, Mr. Hintze became Sir Christopher Hintze. And it's reliably managed, GPM. And consistently, the shares are quoted at a discount to net asset value. So when I had a quick look this morning, there are about 26 pence to buy, but net asset value of GPM is the order of 33 pence. Well, gold shares being the way they are, and it's largely invested in gold shares, particularly Australian gold shares being the way they are, they can sit dormant for years, but then suddenly the market changes its mind and decides to have a real go at them. And if that happens, the net asset value of GPM will, I assure you, rocket. And the next problem will be And investors who want to get involved in what they see as a major run in gold share markets won't know what to do. GPM rarely is the only pure or purish, there's a silver business as well in Chile, whatever it is, the Mexican miner, uh, stuck in there. And the way for them to get involved is to buy the trust. And if and when British investors wake up to the appeal of GPM, these shares will rocket. And therefore, for those who like a protective bet on the price of gold, and why not, this would be an opportunity. I've never understood Bitcoin. It's completely beyond my brain. I can't cope with it. But basically, when they were $500, I think they're about $62,000 or $63,000 this morning. I refused to get involved because one did not get an advice certificate saying you, Mr. S. Cawkwell, are the proud owner of a share of a Bitcoin. And I refused to get involved in that sort of investment. The idea of investing in outer space without a certificated entitlement does not appeal to me. Anyway, for those who keep their record of how they access their Bitcoin account, it's been a huge run. As to when it stops, I have no idea. But to be a bold bunny who says it's going to stop tomorrow, it doesn't look that way. Changing elsewhere, turning elsewhere, there are two companies I've had on my radar. One is Pantheon Resources, PANR. I'm assured by people I trust and whose judgment I trust that Pantheon's exploration acres in Alaska are colossal. And one day, these are going to be financed profitably. And one day, this means that there will be a bid for Pantheon, I'm told. At what level, I don't know. They're around 26, 27p as I speak. But I'm told that it will go out at over 100 pence. Well, whether the oil is there, I don't know. Whether there is a bid, I don't know. Or if there is to be a bid, when? That I don't know. I well remember Andy Brock of Schroders telling me many years ago that the trouble with oil shares, the drilling and exploration side, is that until the oil is above ground, you really don't know what's underground. Well, I'm not that pessimistic. I think it's fair to say there's probably a huge reserve of oil at Pantheon. As to where and when all this is resolved to the happiness of shareholders, I don't know. Anyway, I draw investors' attention to that one. Elsewhere, I cover, in a sort of way, two shares where I'm afraid I couldn't possibly buy them at any price. The first I have in mind is Victoria, the old Victoria Carpets. And the ticker code is VCP. They're around 250 pence at the time of speaking. I thought, perhaps 15 years ago, that this was a nailed-on short. The reason for my so thinking was that some lady contacted me, and she knew uh, about what was going on in Victoria, or at least she said she did. And I thought, golly, this is a slam dunk collapse. But it hasn't happened. And a New Zealander called Jeff Wilding or something like that has kept uh, these shares up quite astonishingly. Indeed, I think he's got a yacht called Resilience. Well, certainly he's a pretty resilient character when it comes to handling his share price. So, as to when the difficulties, as I imagine, would emerge at Victoria, I don't know. But I certainly wouldn't hold them. The problem is that if you want to borrow them to short them, you'll be asked to pay about 25% per annum to do so. Well, I don't agree with paying 25% per annum. It's far too much. It just upsets you to see all these debits week after week going through on your account, and you've got nothing to show for it. But for those who have some way of getting around this problem, I suggest a short in Victoria. Elsewhere on the short tack is one which my friend Matthew Earl of Shadowfall uh, has done a lot of work. He doesn't agree with Dark Trace as an investment. Basically, Dark Trace was established by a doctor, just joking, Dr. Mike Lynch, who established autonomy and sold it out to Hewlett Packard, with some difficulties now for himself personally, since he's awaiting trial for fraud while sitting on bail in Los Angeles. And he had to go there. I think he was extradited. And the fact is that there are features of Dark Trace which are very unsatisfactory. The first is that there are questions, and there were questions, there still are questions, to answer over his conduct at autonomy. And the staff of Dark Trace were often enough with him at autonomy. And I think that once people get into the habit of producing figures which are unquestionable, they don't lose the habit. Therefore, I'd be very cautious about an investment in Dark Trace, and I'd happily sell it. And you can borrow lots of stock there at a reasonable cost. You'd have to agree that with your provider. But I mean, to pay 5%, say, per annum for the right to be, not the right, the opportunity to be short of Dark Trace for perhaps a year, I don't know. It seems to me well worthwhile. And I think that that is something for people to consider. Finally, if I'm allowed to use that word, I would just mention that a bit of an opportunity came up or came back the other day when it emerged that not one but several banks have been involved in lending money on the purchase of motor cars from showrooms. Here, they have often been given an opportunity to borrow money from, say, Lloyd's or Barclays, whatever it is. And also, as it happens, one I followed is Close Brothers, ticker code CBG. Only as a buyer of a motor car, you are apparently not able to decide what rate of interest you're prepared to tolerate. You have to be regarded as a consumer who receives advice from some body on the rate of interest being charged to you because it's consumer finance. Well, I think this is just yet another example of government wasting people's time and money and energy. But the result is that a lot of these borrowers, even if they paid off their loans now, are now entitled to get a refund of the interest which they paid. Well, it can't be, surely, all the interest they paid, but perhaps the interest which some judge reckons they would have paid had they not taken this route whereby the banks were paying commission to the car show to arrange borrowers coming into the car showrooms. Anyway, what will this loss mean? Well, the figures vary enormously. What it means for, say, Lloyd's and Barclays, to name but two, I don't know. A figure bandied about, whether it's accurate, I don't know, is 16 billion pounds. But I think it's more sensible to consider what the position will be for Close Brothers. There's a very good reason for doing it. Regardless of what goes on in the established major banks, Close Brothers has always been, for many years, a brilliantly run business. And I'm sorry for them that they have found themselves having their reputation tainted. When I looked this morning at the share price, which I remind you was way up towards 1,000 pence only a few months ago, I just wonder, Close Brothers itself touched about 285 pence. And as I say, it's about 375 pence this morning. But you know, it's possible that they'll only have to refund their borrowers to the tune of about 100 million pounds. Well, that's nothing for Close Brothers. They've got net assets of 1.4 billion. So who cares, in a sense? I mean, I know the directors object, but the fact is, in relation to Close Brothers' true underlying financial position, 100 million pounds may irritate, but it's certainly an immensely affordable sum. They can take it into account. And so I think it's wise for investors to pay up to 500 pence at Close Brothers. I hope I haven't misled anybody there. With the best will in the world, I try to avoid misleading people. And if I have done that, I apologize. But I certainly think there's a stock for 2024. It's a liquid market. And if people who like to watch shares hour by hour, day by day, Close Brothers is the avenue. Well, I think I've said all I can reasonably say on this occasion, and I trust investors have a terrific rest of 2024. And when they come to reconsider matters in March 2025, I hope they'll all have made a lot of money. Good day.